Hey there, everyone, and welcome to our Pellegrini Financial fourth quarter market update. 2021, a year of recovery, catch up, and accommodation. And it certainly was an interesting year in the sense of what we kind of went through and the type of markets that we had, which started with, yes, recovering out of the COVID pandemic of 2020, which most of us thought we would be done with at that point. We had certainly the economy was trying to catch up in different ways, and accommodation from both central banks and governments to keep the economy functioning. And so when we look back through the year, certainly in from Q1, we had a little bit of a hiccup in January in regards to market returns, but really a steady Eddie year throughout up until September, where we had a bit of a pullback, and into this fourth quarter. Something actually would have expected the month of October to be a little bit negative too, but defying expectations, markets turned, and more than anything, ran through to the end of the year beyond what maybe most economists and financial experts would have expected at the time. And to end up really where 2021 was an exceptional year for market returns. When we look at the indexes in particular, through this last quarter, both the Canadian market and US market were quite strong. The world market, broad world market, actually was the best performer. Year to date, essentially the US market led the way with 25+% returns, depending on the type of index. Canada was not far behind. Europe was strong. I think where it lagged, of course, was out in Asia, in particular, in emerging markets that struggled a little bit. Asia, of course, more than anything, China, which was negative through 2021. But generally speaking, markets were beyond expectations, and that shows, of course, on returns and statements. When we look at various sectors, um, probably a reversal of fortune, especially for the energy market and that space in particular, which was negative in 2020 by quite a bit, performed exceptionally well in 2021. So we saw quite a rebound in that space. Probably not back to where it was perhaps pre-pandemic, but certainly a phenomenal year for energy. Real estate financials were also strong performers in 2021 that weren't in 2020. IT still a prominent sector and always will be. Certainly didn't perform to the same level as 2020, but 2021 certainly was a good year for IT as well. When we look at interest rates, and again have this chart maybe a little different than previous ones, but looking at the 2 and 10-year government bond yield spreads, more than anything, we've seen 10 years pretty stagnant or steady over the last 9 months. In the last couple months in this fourth quarter, really it was the 2-year returns now that closed the gap a little bit there on the 10-year rates. And I would say more normalizing to some extent. Certain by no means are they normal pre-pandemic, as you can see in this chart here that showed where rates began before 2020. We're not quite to those levels, but it's certainly more normalized. And that's positive, obviously, in the grand scheme of things. In the regards to interest rates, and this is more looking at central bank rates, and of course, you see the first number of bar charts there that are minuscule, and those are basically the Western countries here that have essentially zero rate policies. And you see a couple there in the negative, Switzerland and Japan, that are both in negative rates. And then on the far end, more of those Eastern countries that have certainly higher bank rates. That is changing. We go through 2022, expect 2, 3, or 4 rate hikes by both the US and Canada and probably European countries as well. The risk longer term is how fast they raise those rates, and obviously debt management going forward. When we look at inflation, inflation, of course, has been trending upwards through the last half of this year. In the fourth quarter, of course, that continued on. Only in the last month did we see that flatten out a little bit. But rates or inflation rates are still at 4.8% here in Canada, 7% in the US. That is expecting to moderate. And you see a bit of a flat line there at the end here for Canadian inflation rate. I think that is changing based on supply disruptions kind of being managed. Year over year comparisons will change that a little bit. Longer term, I think there's still a concern for energy costs that remain high and will cause inflation, food costs, and I think wage pressures now are starting to creep into the picture as well. When we look at commodities in particular, again, looking at the energy matrix here, Crude oil, Brent, WTI, of course, all had strong recovery years in 2021. Still a bit of a discount on our Western Canadian Select, but certainly not as much as before. Natural gas was strong, which was kind of expected. I think one of the positive things when you look at the metals was copper was strong through 2021. Copper, of course, being fundamental in manufacturing, is usually kind of a sign or signal that you have a healthy economy underneath it. So strong copper prices are certainly good. When we look at precious metals, gold and silver really did not do much for the past year. Silver in particular kind of slid um, into negative territory. Currency wise, Canadian US dollar, there really wasn't much change year over year in regards to the Canadian dollar from where it started to where it ended. Obviously, we had little ups and downs through the year where we topped out, 83 cents there at the middle of 2021, and then it pulled back. I think longer term is still a positive outlook for the Canadian dollar. Again, based on strength of energy prices in particular, and rising rates across the board, I think certainly are attractive to supporting the dollar and the currency as well. Most other currencies, whether it's the euro, we've seen some depreciation. Mainly the Japanese yen was probably falling back more than anything. When we look at 22 going forward, I think it is getting to the point now where this pandemic is now turning into endemic, and that's a lot of the words and verbiage being used with the health authorities. GDP is still expected to be robust, especially in the US. Um, I think the key word for 2022 is moderation, both in regards to expectation for market returns, moderating inflation rates. I think just a moderation in regards to economic growth. There's still certainly some pent up demand. Um, and I think that's still positive. And even business earnings, I think we're expecting that to be quite positive through 2022 as well. And so, while it won't be the same kind of year as we had in 2021, or certainly don't expect that, 2022 will be interesting to watch as we evolve into this endemic now, and also in a rising interest rate environment, how the economy reacts. So once again, I think that's good for now. Thank you for joining us, and we hope you took something from this market update. And we look forward to seeing you again here in the near future. Bye for now.